Hi everyone, it's Chelsea here, bringing you another segment of Living in Southwest Florida. Before buying a home in Fort Myers, Cape Coral, or anywhere else here in Southwest Florida, a buyer needs to decide whether or not they're ready, willing, and able to buy a home. While willing is a personal preference, ready and able might have some factors at play, and one of those is going to be the finances behind the purchase. There are lots of ways to purchase a property, and today we're going to be speaking with one of my favorite lenders, Susan Egan, to get a little bit more information on things that you need to consider when structuring finances for your home. But before we jump in, really quickly, it would mean a lot to me if you go ahead and hit that like button so that YouTube algorithms share this information with others and it lets me know what you'd like more of. As a thank you, here's a video I shot just before the hurricane in Matlacha in the backyard of a home looking out at the bay. This view was incredibly peaceful, as I'm sure you can see, and the home and the dock are both still standing, although the tree I'm sitting under did take a bit of a beating. Really quickly, I also wouldn't be good at my job if I didn't remind you how much we love helping people from all over the country buy and sell their homes here in Southwest Florida. So if you or anyone you know of are even thinking of moving, then feel free to use this contact information below. All right, let's jump right in.
Okay. All right. So, hi, Susan. How are you?
I'm good. How are you, Chelsea?
Good. So, I asked you to sit down with me today. I'm just in case anybody doesn't know, I'm Chelsea Robinson with Keller Williams Fort Myers in the Islands. And I'm with Susan Egan here, and we're going to talk about tips and tricks to financing your Southwest Florida home. So, I was just showing right before we started the call some of the statistics because they just came in. Um, Literally since today is December 1st, we now have November statistics. And I was just showing them to Susan. So we're looking at a drop off here on new listings, but kind of to be expected while people are doing the work, right?
Yep.
This is for Lee County specifically too. We're looking at only Lee County right now. Median sales price is currently sitting at $435,000. And the other one we were looking at was closed sales, right? So that's dropped down. And that's again to be expected. A lot of people are doing some work right now. Some people have pulled off market. We're kind of figuring things out still. So I wanted to pull that up though, specifically median sales, because I know we're going to be talking about like what do some of these numbers ultimately end up looking like for people. Why don't we talk about like different ways you can even buy a house first? So, Susan, why don't you go ahead and introduce yourself since I kind of just kept rambling.
No, you're fine. Hi, everyone. I'm Susan Egan from Allied First Bank. I've been doing mortgages for what seems like centuries, but just a couple decades, I guess. I worked for, like I said, for Allied First Bank. We have a ton of different programs. We're a lender and a broker. What that means is we lend with our own money, as well as having the ability to broker out with numerous banks if you have or need a specific product. So sometimes it's something more than just FHA or conventional, and that way we broker those files and we are able to offer you more programs. So hopefully we'll go into some of these interesting programs today, on different ways that you can finance and buy a house.
Thank you. Okay, so let's talk about them. What are some of the ways that we could look at where you could buy a house? And obviously there's cash. So some people
Sure,
choose to do that. And we do see a lot of cash rolling through this market
absolutely.
right
Cash
now,
is great.
right?
Yeah, I think in the statistics, the cash was up. Typically, you don't need me for cash. However, if you are buying a house that needs a lot of work, for example, let's say you're an investor from out of town or even in town, but you are not looking at it for your primary residence, trying to figure out how to build up that cash. You can always look into a home equity line of credit. You could refinance cash out. In fact, this might be one of the best times to do that because the values are high. So you're able to actually use that, equity that you have in your house and leverage it to purchase other properties. So cash is king, and that is definitely a good way to get cash if you don't have it.
Yeah.
For
Yeah.
sure. And I know we talked about there's tons of programs here, but let's start with your typical FHA, VA, there's USDA and conventional. So those are your 4 core products in a sense. And so with conventional, if you're a first-time buyer, you can go as little as 3%. A lot of people don't realize that they could get in for such little money. So 3% down. FHA is, you don't need to be a first-time home buyer, but that's 3.5% down. And the more money you put down, like the best conventional rates, let's say, are usually around 30% down. But again, these are very, very marginally off. So whether you put down 5% or you put down 30%, it's not a huge difference. But if we're trying to figure out what's the very, very best, that's what you would look at. And then for VA, the best, it typically comes, most people that do a VA loan, they get to do it with no money down. Of course, that depends on a slew of factors, but let's say that's the most popular program for VA typically is the no money down. And that's also a really good product if you're a veteran, because you don't have to pay, private mortgage insurance with that. So that's one of the benefits that VA does have for you. And then,
I'm gonna
they
stop you
offer
real quick there,
FHA and
though.
VA.
I'm going to pause you right there real quick because you mentioned private mortgage insurance for VAs that would get skipped. And that is something that most buyers will need to take into consideration unless they're putting a certain percentage down, right?
That's correct. But the very interesting thing is that sometimes you don't have to meet that 20% mark to get rid of the private mortgage insurance. So for example, if you're doing a conventional loan, you could put down 15% instead of 20, and the rates are actually slightly better at that 15% than they are at the 20, as weird as that sounds. And then you buy out the private mortgage insurance portion. So you can pay an upfront fee and buy it out, or you could choose to take it. The more money you put down, the lower it is. But if you don't want it at all, that's another way that you could, potentially put down 15% plus a little extra to pay that off. And you don't have to meet that 20% mark. Now, FHA loans, they always come with mortgage insurance. Doesn't matter how much money you put down.
That's good to know. I know we actually utilized paying the lump sum for it. I think we put down 18% for a property. And so we were able to just roll it and pay the difference with our closing costs. So
yeah, and you can even finance it. So you don't necessarily even have to pay it out of your pocket. You could pay it in your closing costs for sure. But if money was tight, you could finance that little portion as well. And so that helps you keep money out of your pocket, or allows you to use it for other things like buy down points, which we could obviously get into.
yes. And I've actually had that work too for an appraisal, which I don't think we're going to be running into issues with that moving forward anytime soon. But I have seen where somebody was putting down 20% and the property didn't appraise, and it was now at like a 16% or whatever it was. It was under the 20% threshold. And so she was able to just roll that in and still continue on with the sale. So some people don't realize that private mortgage insurance can be removed essentially. Let's talk about, so I had stopped you at the private, right before the private mortgage insurance. We were talking about the conventional. So if you want to continue, or no, I'm sorry, you were still talking about VA.
Sorry, Chelsea, you cut out just a little bit.
Yeah, I had you freeze.
Did I freeze on you?
Yeah, it's okay. We were talking before I cut you off. I think we were talking about VA loans.
Yes. So with VA and FHA, what I was saying was that you could have, lower credit scores typically with those, so they don't have to be as strong. You can have a few blemishes on your credit usually. and be able to obtain those. And they also come with higher debt ratios, you know. So if your debt ratio is a problem, then, you know, we could potentially look at one of those products and see if that could help you.
And when you say debt ratios, what does that mean?
So there's a income to debt ratio calculation that underwriters use in order to figure out if you qualify for a loan. Basically, it takes your, you know, your gross income, assuming you're a W-2 wage earner, and it takes your monthly minimum payments of bills, including your new proposed mortgage. And so that is basically your debt ratio. A lot of people, know, sometimes I'll read online or whatever, like, oh, I figured out my debt ratio is this, and I probably won't qualify for much. But those people really, really need to reach out and speak to a professional, just because you know, we look at things a little bit different, or we can help you figure out how to get the ratio lower, or I can tell you, well, that rate, that number doesn't count, I don't need to use it. So please don't do your debt ratio yourself. That's I beg you for that. I'll be happy to do it for you.
Excellent. All right, so we've talked about VA, and have we covered like the solid points on FHA? Would you say? Is there anything more people really need?
I would say so. I mean, FHA is great because you can get a lot of your closing costs paid for you as well if the seller's willing to do that. And so, especially in this market right now, I think sellers are maybe able to negotiate a little bit more than they were, you know, 6 or 8 months ago. And so that's something that you could look into. And with FHA, they can pay, you know, 6% of your closing costs. So pretty much usually that should cover the whole thing, depending on the price of the house. So I think those are the best products right now, because we're in, you know, Florida, and we had Hurricane Ian come here and destroy some of the houses. There is a couple of other options. There's a new program called a 203H. Basically, it's a sister product of the FHA loan. And so it uses FHA loan limits, and it uses FHA qualifications, as well as the twist, so to speak, on what you can do if you qualify or not. So for example, your house has to be unrepairable in order to qualify for this program. But the benefit of the program, if you fall into that category, is that you could theoretically buy a house with no money down. So, and the other major thing is that that particular program will ignore your current mortgage payment. So a lot of people's like, how do I buy a house when I already have a mortgage, even though I can't live in the house? Well, that specific program will allow you to exclude that mortgage payment from your debt ratio. So that's really the biggest benefit of that product. The possible downfalls of the product is that at the moment, there's, you know, this is all, the 203H is not a product that someone like really specializes in, right? Because it's literally, the houses have to be inhabitable. So, or they can't be repaired. So it's not something that many people have a ton of experience for, unless you just travel to disaster areas all the time. So,
you're licensed everywhere.
So, so right now people are, you know, in Cape Coral, for example, are having hard times, you know, getting proof. Like one of the ways you can prove that your house is not rebuildable is through insurance paperwork. So you could either get insurance paperwork. If you can't get that, you might either have a city write you something. If you can't get that, you could do a private, hire a private home inspector. I know the banks are willing to look at that as well. And if you get those things, then sure, you might be able to get, you know, benefit from that product. And they don't come with, just to be clear, they don't come with any special interest rates. So they're not like, it's not like a 2% rate just because you lost your house. They're normal, you know, FHA rates. So that should be, you know, just keep that in mind as well.
That is good to know, because there were rumors going around that they were at extra low rates for those who needed to use them. So that's good to know.
Yeah, there's other programs out there, you know, that you can get like a personal loan, like and those come with really low rates, like the SBA loan. It has nothing to do with mortgages, and it seems weird that an SBA loan would be out there, but it is. And so, you know, those do come with really low interest rates. Unfortunately, I've heard a lot of people getting denied for those, and I'm unsure of those qualifications because again, that's outside the mortgage realm. Um, but it is definitely a possibility. If you were affected, you could look into something like that. The other important part of the 203H is that it's got to be within a year of the disaster. So the timeline is really important. And, you know, if you were affected, it's important to jump on these things right away, because we don't want time to lapse. And again, be patient because everybody's, you know, the cities are figuring things out. The insurance companies are figuring things out. So it doesn't move very quickly. With those
Cape
projects.
Coral, speaking of the cities trying to move on, they actually just sent out an email literally an hour and a half ago saying that they were just now this week, they'll be finishing their first pass on debris pickup, and they should have second passes of debris pickup done by the end of the month. So like we are still very much figuring it out.
Yeah. It's a mess out there. So
Yeah.
but it is opportunity for some people, you know, to purchase homes. And it is also
And it is getting better.
Yeah. And also just like stirring up stuff too. You know, more people are moving now, more people are thinking, you know, what matters to me in a home, different things like that. So that's very important. But today we have some good news. I'm going to change the subject now. We have some good news today because I'm so excited that Chelsea, for the first time in a while, I've seen rates in the 5s today. I know. So, I mean, they were above 7 at one point. And so why are the rates low, right? Like the rates didn't go down. The Fed didn't lower the rates. Why are they low? And I'm saying low, but lower, right?
Right. Well, I mean, statistically, we are still low, right? Like, I know I saw a graph maybe a couple weeks ago that showed that like historically interest rates have been 8% as the median rate.
Yeah, so I mean, I've been saying that for a while, probably for like 10 years, and I'm not sure if that statistic is actually accurate because as time has gone by, rates have been really low. So I've been doing mortgages since the 90s, and rates, I know that I did mortgages in the 7s, but I was like early 20s. So so rates, yes, statistically, it depends how far, you know, you're looking, like for all of time, or in the last 20 years. So in the last 20 years, these are kind of higher interest rates, but in the 5s, I think is a good rate. Anytime you go below 5, like I remember, you know, I want to say if I had to guess, you know, in the early 2000s when rates went, you know, just below 5, and my company had me at a mall, Chelsea, and I'm like, oh my God, road rates are 4.875 today. Why am I at this mall? I have my clients to lock. So I just have that vivid memory. And so rates, you know, in the 5s are decent rates. I don't know if we'll ever get to the 2s or 3s. Those were, you know, kind of COVID rates. So like, you know, what's something crazy happening in the world? I mean, it wasn't just the US, it was everywhere. So I do believe that those were extremely low because of that. So what is low? If you remove the COVID part of it, then I would think in the 5s and the 4s, those are great rates. I don't particularly look at 6 as high either. But of course, it depends how old you are, right? So if you're talking to somebody who's, you know, just ever since they've been an adult, they see low rates, then it seems a little bit higher to them. But of course, if you talk to older people, they're like, oh, I had an 18% mortgage, you know, back in the day. And one of the things I always say is that, you know, if you do get a mortgage and the rates are higher, then it's, you know, if the prices are a little bit lower or not as high, then you're actually making out because, you know, refinancing is a lot easier than paying down $50,000 on a mortgage, 100,000, depending on, you know, the house you're looking at. So I do really believe it's a great time to buy right now for those reasons. But one of the reasons why interest rates came down is that, you know, first of all, Powell spoke, and basically he said that he was not going to be raising rates at such an aggressive level. And so the December, because every time when you look into interest rates, the way that those are figured out is it's always on hedging. It's always on what the market is going to do, not necessarily where it's at right now. Over the last 20 years, you know, they had a buffer of like 175 to 200 basis points above. Right now, we were running, and I don't know where we are at the moment because we dropped, right? But we were running 300 basis points more. And what that means is that they were figuring above and beyond. So those rates really should have never really been 7.25, for example. They should have been a little bit less if it went on the 175 basis to 200 basis points over.
Mm-hmm.
So we're kind of getting more back into reality. It's not like you're going to see a huge drop in rates. You know, I don't expect me, you know, if we had this meeting next month to be like, hey, rates are 4.5. Like, I don't see that. But I definitely do see that the leveling off and the, you know, of the interest rates and not going crazy. And at such a fast pace. So for those reasons, I think we're getting into a little bit normalcy. And when the interest rates go down and the word gets out, then properties start selling at a faster pace. So it's important for you, like if you are on the fence, you know, grab that, those types of rates right now and go from there, because, you know, it really does make a difference in your payment.
Yeah. I'm gonna pick your brain a little bit here on, do you have any forecasting you'd like to share, like what you kind of expect you might see?
Well, I mean, this is pure guess.
Speculation.
Obviously.
I mean, none of us are fortune tellers, right? So
None of us are fortune tellers. You know, it's funny because there's like two schools of thought. So you speak to, like, in the mortgage industry. So there's people that are like, oh, rates are going to go double digits next year. And then there's the people that are like, well, by the time the end of next year comes, rates may come down. And so each of my clients, based on their risk tolerance, based on their affordability, is when I decide, do we do a lock? And so, you know, it's on a 30-day lock, it doesn't really matter. But when you're talking about a long-term lock, if you are building a house, for example, and your house isn't going to be ready for a year, and your debt ratio is 48 for 49, really high, and let's just say the max is 50 for your program, then I'm not going to chance that you're going to, you know, not qualify in a year. So, so basically for those people, I would say, let's lock your interest rate in. Worst thing, this is the highest rate you're going to get. They do have float downs available, so you can always go to a lower interest rate should that happen. And there's specific rules to that. Basically within 45 days, this is again, every bank is different, but generally within 45 days of closing, 30 days of closing, you look at the interest rates. If they're lower now, they do usually allow you to float down. But that is very specific. You have to make sure your lender talks to you about it and knows which products that you can actually do that with, because some of you can't float down. So it really depends on, locking really depends on your specific situation. We also do have, you know, the ability, if you lock and, you know, the rates go down a lot, we might be able to just relock you as well. So that's a possibility as well, depending on the situation. We talked a little bit about the 203H program, but I also want to talk about the 203K program. So and FHA is 203B. So you hear these 203s, you know, that's your FHA marker there. So the 203K comes in two different formats. One is called a streamline, and one is not a streamline. It's just regular 203K. So if you're doing the streamline part of it, it's just a little bit easier. You don't have to have an FHA consultant, which is basically a person that oversees the project. But it's also based on, first of all, the number, the 35,000. So usually there's a buffer, so you can't get the full 35,000. So let's just say 30,000. It's a little higher than that, but I'm just rounding. So let's say you need 30,000 in your loan, and you can, you know, occupy it very quickly. Then you go with that smaller program. Well, if you need
the 203K is a renovation loan, so this is going to be done specifically on homes that need some work, right?
Yes, but you theoretically can use this product even if your house doesn't need work, but you want it to have work. So there's no like specific guidelines. There's specific things that you like. You can't add a pool, for example, but you can fix a pool. So so you can't do additions, but you don't like the kitchen, you can change that out and get a loan with that. So the 203K is a very good unused, I shouldn't say unused, but it's kind of a niche program. Not many people use it. But it can really help you if you're looking for that. And also conventional has a renovation program too. It's just that the FHA one allows you to exceed the value of the house a little bit, where conventional doesn't. So, FHA will do the subject to value and allow you to go above 100%. So that's kind of interesting, niche that they have.
Yeah.
And then at this time where interest rates are on the little bit of the higher side, and we eventually expect them to go down, once you get into that rehab, you can certainly refi into a conventional loan or get out of that loan. No properties that are owner occupied should have any prepayment penalties. That went out years ago, so that you shouldn't be running into that situation. So doing the FHA 203K renovation product, the 203H disaster product, there's definitely, or even the conventional rehab, there's a lot of programs out there.
And I want to add too for 203K. You did mention that there are certain stipulations, like you can't add the pool, you can't add the addition. I want to say too, there was no major structural things too, right? Like,
so the
foundation problems and things like that.
Yeah, so the 203K, with the consultant, as long as the consultant feels that the work can be done, then you should be okay with that, and be able to fix that type of stuff. But sometimes, like I had a client one time think that they wanted to spend like 50,000, and the consultant was like, you're looking at 130,000. So it's really good to have these consultants, because and to be honest with you, the success of your project is based usually on that consultant. So definitely, you want to pick somebody good, and it's hard to know who's good. Kind of got to go on reputation. Excuse me. Other than that, other great things that happened today, or 2 days ago, I should say. Conventional loan limits went up, Chelsea. So what did you say the median price was now?
It is now 435, I think is what I had.
Okay, perfect. Excuse me. So our loan limits went up from 647,000 to 726,200. So and that's like the standard across. That's not like a high cost area. High cost areas, you're looking at over $1 million you could do as a conventional loan without getting into jumbo and jumbo guidelines.
Right. Yeah, and I was going to add, so that threshold means that if you were to exceed that number, then it switches to jumbo mortgages, which is a whole nother kit and caboodle.
Correct.
Can you give me that number again? I'm going to write it down.
Sure. 726,200. So FHA has not yet released what their number is going to be. Okay. But since I get to make predictions, I'm going to make a prediction. Okay. So FHA usually runs right around 65% of that number. So right now we're at 420,680, and we might be somewhere around 472,000 for an FHA loan. Awesome. So anything, again, 203K, 203H, that's still FHA, still follows those maximum guidelines. And what those guidelines are based on is when you pull that FHA case number. So if you're eyeing a house that you might want, it's important for us. And let's just say it's between, the 420 and 470, for example, for the loan limit, until January 2nd to pull that case number so that you can get that higher loan limit. If you pull the case number now, you're going to be capped at the now numbers, even if you close in February, for example. And again, this is not a published number. It could be different than this. So just understand, I'm just giving you a guess. I'm hoping that, I check every day. I'm like, where's these numbers? So I'm hoping they'll come out very shortly, and we'll be able to share the accurate number with you.
Yay, that sounds exciting, especially because I mean, both of those are above what our median price point is at this point. So, that means that there's a lot of opportunity out there for people.
Yeah. And to it might not mean a lot to the general public because this is like mortgage stuff, but there are new products that are coming that have loan adjuster caps in a sense. So what that means is that basically first-time home buyers that are doing conventional there was always like, oh, well, if you're this, there's a hit for this hit, meaning the price is more in points, it'll be more. So they put caps on those. So it'll be more affordable. So even though rates are going up or, that they're on the uptrend, except recent, right? These loan level adjustment prices hopefully won't put you too high. So they've capped those, which is another good win in the mortgage industry.
Very cool.
Yeah.
Nice. And I did not ask you to explain this in advance, but just so people understand, can you give like a very general idea of what switching over to jumbo, like the difference between conventional and jumbo would mean to somebody?
Yeah. So it's basically like your down payment changes, right? You can't buy 3%. You can't do it with 3% down. You can't do it with 5% down. So usually 10% down is where they start. Jumbos, sometimes jumbos have better interest rates than conventional, as weird as that sounds. But they right now the paper is just isn't coinciding with that. Although a lot of times that was the case, at the moment, I'm not seeing that because there's a lot of utility that they just pull back. So that's basically the biggest differences are those things. And generally the higher credit score you have, the better. One of the things that happened is that, typically 620 scores was what got you in the door for conventional loans. And over the last couple of years, it's been very difficult to get a loan approved with minimal down payment at a score that high. I'm sorry, that low. While in the past you would be like, oh, 620, you're in the door. Now you're not in the door. So you have to look at FHA or increasing your credit score, which we tend to do a lot with clients because it makes a difference in interest rate too. So sometimes even during the process, I can take somebody's 620 score and turn it into a 680. And if you lock at the 620 score, for example, and then end up with a 680 score, they will usually honor that 680 as long as you get that to them before closing. So we're always trying to, help clients out and save the most amount of money with those types of products too.
Excellent. Can I ask a little bit about assumability? Because we talked about VA and FHA, and I think that's going to really be important for people moving into these markets with the higher interest rates.
Yeah, so VA and FHA are assumable mortgages, provided that you qualify. So if you're a veteran, you could assume a VA loan. FHA, you could theoretically, assume the loan under certain circumstances. I'm going to use myself as an example, Chelsea, because
done this.
Yeah,
sort of, right?
Sort of. So the reason why I'm using in a sense as a mortgage person, right? So you don't go to a mortgage professional to assume a mortgage. Most times, I have a house that's FHA, and so somebody could assume my 2.25 interest rate. Just to give you some numbers, my mortgage was for $300,000. It has like 28 years left. So you assume the whole term. So you would assume the 300,000, the 28 years left, and you just basically take over those payments. And it just sounds really, really fabulous, and it is. But there's some caveats with it. So first of all, if the house is listed for 600,000, someone has to pay that difference. So basically you have to have the cash for the 300,000. You could theoretically, if the lender that's assuming allows, you might be able to get like a home equity line of credit or a second mortgage or something like that, to go behind that. But from what I'm understanding from the community of people doing this, very few and far between will accept that secondary mortgage to go behind it. So the best case, the best ones are for people that do have the cash already, or again, you can refinance it on the property. That's, something we're licensed in all 50 states. So sometimes when somebody comes in a scenario, I tell them, well, let's refinance your house and take the cash, and wherever they live, I can help them in the United States. So having said that, that part of it is good. So what I did, because again, no experience with assumability, has nothing to do with me as a mortgage professional. So I called up my bank and said, hey, listen, I have someone that wants to assume my mortgage. So I wanted to be ahead of the game because I wanted to know what the process was. So I asked them to send me the information, and they sent me their assumability guidelines. And my servicer is Mr. Cooper, as many people have. And Mr. Cooper said it was a 6-month process. So again, the seller has to be good with, and again, like Mr. Cooper, you might have Wells Fargo, you might have somebody else. So you have to reach out as the seller to your servicer and find out how long it is. I'm not saying they're all 6 months, but that was my experience. So a lot of times, again, it sounds fantastic to assume somebody's mortgage. It's just sometimes hard to pull off.
I will say too, there are probably very few out there, because we have had so many people using cash in this market in the last several years. And we have had struggles with the strong sellers market getting FHA and sometimes VA loans for buyers to be able to be accepted offers to use those products to begin with, that they aren't the majority of our homeowners out there right now.
Right. And the thing is that unlike a pre-approval letter, which you have like a mortgage person that sits down, reviews and says, oh, you qualify, who's to say that this person that is going to assume the mortgage, who pre-qualified them for the assumability, right? Like nobody's checking their debt ratio, that you're just filling out some paperwork, sending it in, and within a few months you might hear back. So it's a little, so just realize what is out there. With the assumability portion of it, I had someone that was really hot on getting, trying to find someone's mortgage to assume. And like I said, I can see why. It's just not as easy as it sounds. You have to have like the perfect storm in a sense to make everything work. With the seller who's patient, with the seller, is the seller going to be okay if it falls apart? What happens then? And so I'm not sure how that would work, even on the language part, like how long do you get for a commitment? Different things like that could be a struggle, but hey, listen, it happens all the time. So if you do find that magical unicorn and you guys can make it work, definitely you look into it. It's a good way to get a lower interest rate for sure.
Yeah, definitely something that's good for people to keep on their radars. Doesn't hurt to check into it if you're somebody who might qualify.
Yeah, it certainly doesn't hurt at all. And again, some sellers might be, willing to do those types of things for numerous reasons. And then, what else was I going to say about that? I think that's it. As far as other programs that we didn't talk about, because we talked about, the basic products. At Allied, I do have the ability to broker some loans. So I can do some crazy things in a sense. You can't really do no income verifications anymore because those products went away. But you can do slight verifications, if that makes sense. So I have a 3-month bank statement program, a 6-month bank statement, 12 months, 24 months. And what they do is they look at the average deposits of the self-employed. And so you're able to obtain a loan just with bank statements without tax returns. I have a P&L product where your accountant prepares a P&L for you, and that's the income we use.
Those are all great for self-employed people.
Yes, they have to be self-employed for these products. So yeah, there's a 1099 only program. So as you know, as a realtor, you get a 1099 at the end of the year, and you're theoretically self-employed. There's a 1099 where they don't look at your expenses. some companies don't look at your expenses. Some companies give you a factor. So your 1099 is 100,000. We're going to give you a factor of 80%. So now you made $80,000 that year. So there are a ton of programs for the self-employed. Don't feel discouraged. I was talking to a client today and he's like, oh, my accountant's great. We took a lot of write-offs. It's like, hey, well, we got these other products for you. And those just typically do come with higher interest rates. Obviously, anything above the norm is that way. But
I was going to add that.
yeah, but if you're willing, but if you need a house, you need a house. And, if your circumstances change, you can certainly refinance. And then lastly, on investor parts, the investment portion, sometimes people don't realize, but when you're buying a house, two things to this. If you're buying an investment property, you definitely do need money down. And when you buy investment property, we as mortgage people use the rental income to offset that. So a lot of people are like, oh, I can't afford 2 houses. I'll never qualify. Again, don't determine that yourself. We can use the rent to wash the new payment. So that's something that is good. Washing just means we subtract your mortgage payment from the rental at 75%. So that's one way you could qualify just conventionally. If for some reason you still don't qualify, or you're an investor that has a lot of properties and you take a lot of write-offs, you just want an easy mortgage. There is a program called DSCR. I'm sorry, DCSR, and basically it's debt ratio, and it's basically debt servicing. So it looks at just the other property, ignores all of your own personal stuff, and just looks at the cash flow of the property. And if the property meets the cash flow, then you're approved. It does look at your credit as well, but not specifically your specific debt to income ratio. So there's a lot of products.
Yeah.
Yeah.
And we do have a lot of investors who are currently moving into the market. So that's really important for them to know that there are options out there.
Yeah, especially when they tend to have multiple properties and sell a lot. And, rather than supplying all the paperwork and all that stuff. And, if they know that their numbers are not where they should be, then that's just a really great product out there to help people, gain property, gain wealth, diversify your portfolio, and add some real estate in there, because even if real estate comes down a little bit, I mean, it's still over time, it's one of the safest, things you can invest in.
Right, exactly. Let's talk about another program. I don't think we've talked about it yet, the Florida Hometown Heroes program.
Yeah, so that's a great program too. It has income limitations, such as the USDA product too. That's another one that's no money down, but that has to be specific areas. The Hometown Heroes, one of the things that surprised me about that program is like, who qualifies for that? Who's a hero? And the list is really large and loose. What I mean by that is, and not picking on massage therapists, because, but they're one of the professions that's a hero. So, so yes, your typical policeman, fireman, teacher, all those people do qualify. You do need to be a first-time home buyer unless you're a veteran. But that product is out there, and it gives you up to, gives you money, I believe 15,000. And it just started in September of this year. So that's for Florida. And I think that it's something that we could definitely look into, especially if you meet the income criteria.
Do you happen to know what the income criteria is?
It's based on your location. So like, for example, I don't know for a fact, but typical median income around here is like 76,000 for the family, but it also depends on how many members in the family. So we would have to be specific with you and take a peek at that.
Got it. What about, I lost my train of thought. I was going to ask you something specific about that too. I hate when that happens.
Oh, well,
I'll remember later. I was like, oh, and I'll just like randomly blurt it out for you.
No problem. No problem.
It was something you said. Oh, I know what it was. See? Oh, the people moving from out of state, do you have, for hometown heroes, do you have to have been in state for a certain time period?
I don't know the answer to that question.
Okay.
Yeah, because to be honest with you, it's not the market share that I usually am in. There's not really that many people that meet that income criteria. So I do not know that. And they're not very they don't send a lot of material on it. So I would have to check for that.
Okay. If you don't mind checking for it, if we can get the answer by publication of this video, because I'm going to record
Yeah,
video,
sure.
then I will add that into the comments or in the description below so people can find out that answer.
I'm gonna guess that there is no, like, I think you can move into it, like just move here and buy, but I would like to double check that. I think
Yeah,
it
a
has
lot of
more to
people
do with,
who find my videos will be moving from out of state, so I'd love to know the answer of that for them.
yeah, that's a great idea, especially if you can update them in a bit. Yeah,
Right.
absolutely. Also, a lot of my clients are remote clients as well. And I just want to say what's important with remote. So when you're a remote employee, and a couple things that you must do. If you're going to keep that job and not get a job, within driving distance, then what you want to do is make sure that your employer knows that you're moving to Florida, because the letters usually require you to say that it's okay for so-and-so to move to Florida or whatever town, if you want to get specific. And there will be no change in pay or state what the change in pay is. So as these remote positions get more and more, the underwriters have gotten a little bit more specific on what they want because, the Florida job market may be a little bit less than, say, New York or California. So if someone's going to work in Florida, they're still going to get paid their same salary. And, the answer is 9 times out of 10, and I don't think I've ever had anybody. I had one person for about one day say that she was going to get less pay, and then she argued, and her manager said it was fine. So I haven't come across a lot of people that their incomes are getting reduced for moving to Florida, but you definitely want to check that out and make sure you can get that letter because also some people just kind of feel like they can get that letter without double checking. And it's really, really, really important because, you don't want to get into a situation in your loan approval is based on that. And then your employer says, oh, we don't feel comfortable putting that in writing. And so that's where it gets iffy. It's like, they're okay with it verbally, but are they okay with putting that in writing? And so that's really what you want to be checking.
Well, and frankly, you want to know how much you're going to be making in the long run anyway, right? Like, I actually have a friend that happened to, but it happened before mortgages really started asking for all of this because it was about 5 years ago. She said she was already a remote worker, moved out of state, and the max paid for her job in the new state was less than what she was making previously, and they forced her to take the pay cut. And luckily, she could afford it. It was a very well-paying job to begin with, but she wasn't very happy about it.
Exactly. That's crazy. But yeah, I mean, it happens. You have to make sure, and some people, it's kind of a catch-22 because some people don't want to say they're moving either. Well, I don't want to tell my employer yet. But you kind of probably should if you're relying on it.
I know we've talked about interest rates being lower today. Can we talk about buy downs?
Yes, we can talk about buy downs. So there are different types of buy downs. You can buy an interest rate down yourself, like with, for points, for example, you can pay 1 point, 2 points.
And a point is 1% of the purchase price, right?
1% of the loan amount.
Thank you.
So,
okay.
Yeah. So, yes, you can buy down points to get a lower interest rate. But one of the more interesting things happening right now is some sellers are paying for the buy downs for clients. And so we actually have a 3-2-1 buy down, and then there's a 2-1 buy down. And so what that means is, let's just say I'm just going to make this up. 5.75 is your interest rate. And then you do a 3-1 buy down. That will get you to 2.75 for an interest rate for the first year.
What is the 3-1 mean?
So it means that, so each step. So basically the first year you get 3 percentage points lower if you're doing the 3-1 buy down. So that's why we go from 5 to 2. And then if the second year, it would go up to say from 2.75 to 3.75. The third year would go up to 4.75. And then, you end at 5.75. And it's not an adjustable rate because you're ending where you're starting, right? Where you would have been. So that's really, important that you realize it's not an adjustable rate. But the seller must pay for this buy down, unlike points, which can be used in conjunction with this, by the way. Unlike points that you can pay for yourself, the seller is the one that pays for this because they're literally paying the difference in interest between the 5.75 and whatever rate you're at. So there's a formula and a calculation that they must, I would give you. And say, okay, well, this seller has to pay 20,000, or we're just doing the 2-1 buy down. This one's going to pay 13,000. Now, if you refinance before that time is up, you actually get that money back. So let's just say you did a 2-1 buy down, you refinance in 6 months to a better rate. Then there's all that money that you actually get back. It's really held in escrow kind of thing. And so it kind of helps you supplement those payments.
Okay. Excellent.
And if you're a seller too, that's a great way to, promote your house.
Right. To offer that. Would a seller be able to obtain what that number might look like in advance so they know kind of what they're getting themselves into?
Yes, there's a formula and a calculation. The 2-1 buy down is by far more popular than the 3-1 buy down, and the 3-1 buy down is very expensive for the seller. So the 2-1 buy, and there's even a 1-1 buy down, so it's just lower for the first year. And actually, there's one of my lenders that pays for it for you, the 1-1 buy down. They finance it for you. Not saying that they're definitely the ones that have the best interest rates, but it could be something we could look at if that's very important to you. And the seller's unwilling to do it. So, but again, you could do the 1 year lower rate, the 2 years for lower rate, if the seller is willing to do it. And it's all based on your loan amount. When I figure out the calculations and the interest rate as to how much the seller would be putting in escrow for you.
Okay. What am I forgetting here? We've covered a lot of different topics surrounding the finances of homes here. So, second homes and investment properties. Can we touch on them? I know we're getting close to 7 o'clock here, so I don't want to take up too much more of your time. Can we can we shorten an entire industry basically to just
we've gotten a lot of products done, so we are good. So second homes, are a little bit different than they used to be. Second homes used to have the same interest rates as primary homes. And I believe that due to a lot of second homes turning into Airbnbs and different things like that, the market now has shifted to being more like investment property. Not exactly, but more like it in terms of pricing. So the before, like if you put 10% down, you'd be able to get a loan. Nowadays, basically the cost is 4.125 points for a second home with only 10% down. So what that means is just, for comparative purposes, if your interest rate is 6 with no points, then it's 6 with 4.125 points for a second home. Now, there are some things you could do to offset that by going to a higher interest rate, for example. But a lot of times, the law will prevent you from only putting 10% down, meaning the cost is too high. So there's a lot of balancing that needs to go on. By far, the best thing you could do for the second home is put more money down because the hits will get less. So you put down 20%, it'll be less. And then also second home, the biggest difference between second home in terms of qualification versus investment is that a second home is an additional mortgage payment you have to take onto your mortgage. So while we talked about investment, washing payments, using rental incomes to offset, with second homes, you can't do that. So second homes, you do not get to use any rental income because even if you rent it out for part of the year, that would, that in a sense, sometimes depending on how long it can turn into investment property, we'll look at it that way. But if you really want a true second home, you also can't buy, like, a second home doesn't mean an additional home. It kind of more means vacation home than an additional home. So like you can't buy a house on your street and then buy a second home 3 houses down. That wouldn't work. That would be investment property. And I do want to talk about one more program that many people have no clue about. That's actually one of my favorite ones. And I had someone call me and say, "Oh, I'm going to buy investment property. I'm going to rent it to my parents."
Tell me
Well,
more.
yes, you are actually, that is not investment property. That is primary residence. So for someone who buys a house for their parents because their parents can't afford it and they have to document that by, say, Social Security award letter, for example, proving that how could I possibly afford a house, right? So they don't have a house now, they're going to buy one. You can, for 5% down, as little as 5% down, buy a house for your parents. You must qualify for both mortgages yourself, and your debt ratio can't use rental to offset it. But that the big part is, yeah, we can help mom and dad with just 5% down.
So you don't have to do those crazy huge down payments or,
Yeah, well,
theoretically.
with investment property, I mean, you really want to put down 20%. It's not really a lot of money for investment. 20% is going to get you lots of points and a higher interest rate. 25% is really where it starts with kind of decent rates, and 30 is the sweet point. So by saying you can buy a house in its primary residence with 5% down, that's a really big thing.
Mm-hmm. Sounds like it.
Yeah. Yeah, it's a great product. I have one right now, actually. And the funny thing is, when the seller, we did the same product for him, and now he's selling it to someone who's doing the same thing, which just a weird coincidence, right? But I think it's just a great product, and a lot of loan officers might structure that wrong and do that as investment, and there's really no need for that.
Good tidbit for people.
Yeah. And also rates. I mean, your rate's going to be way better on primary residence, right? Than investment as well.
Right. Did we forget anything?
I don't think so. I think we covered a lot.
And a lot of this stuff too, like, can be very nuanced, right? Like, it very, very dependent on people's individual circumstances. And, and so it always is going to need to require a conversation to be able to kind of figure out what exactly is going to be the right boxes that'll work.
Yes. And also, like, a lot of the stuff you can't combine. So, back when I used to do ads, I'd be like, "Oh, this program, this program, this program." And they'd be like, "Oh my God, I'm that one day out of bankruptcy and no money down and an investment." Like, so some of these things you can't combine them. So definitely reach out to me, and we can talk about your options, get you pre-approved for the best possible product, in the best way for you.
Great, thank you. So if people who are watching this, if you have any questions for either Susan or myself, need to drill down on any specifics, different neighborhoods, or different loan programs or whatever, feel free to reach out to us. Our contact information is going to be below on the recorded video. If you're watching this live, I can get that to you. I do I can do that. And we will get that ball rolling for you. So thank you for your time. I appreciate your time.
Oh, absolutely. It was a pleasure. I hope people found it interesting.
Yeah. All right. Thank you.
You're welcome. Have a wonderful day.
You too.
Let's hope these rates keep going down.
Yes. Have a good night.
You too. Bye-bye.
Bye.
If you have questions about this for either Susan or myself, or if you'd like to drill down and compare specific neighborhoods, like say Cape Coral versus Fort Myers, or waterfront homes or pool homes, or whatever your specific circumstances call for, then feel free to reach out. The contact information below in the description. Myself and the network of agents I have throughout the United States are here and ready to help you with your move. My video schedule can sometimes be erratic, so if you'd like more videos like this, then don't forget to hit the subscribe button so you'll be notified when we drop another one. And if you're ready to go ahead and get that ball rolling on your move here to Southwest Florida, then there is a link in the description below to set up a personalized home search that'll be tailored specifically to you. Oftentimes, when you search on web aggregates, it limits your capabilities. But when I build the search for you, we're going to have many more options available, and we can begin to have that conversation about what your home in Florida will look like. Or feel free to use Cape Coral Fort Myers realestate.com for all the latest listings to hit the market and begin getting comfortable with what our marketplace looks like. No obligations. And don't forget to add me to social media and follow along as we post weekly articles and information that you may find handy and give you some insight as to what life in Florida looks like. As always, we really appreciate it when you leave us a comment and hit that like button, subscribe button, and notification bell so that you can be notified when we drop future videos that may help you with living in Southwest Florida. Thanks so much for watching. Until next time, we wish you much health and happiness.